Bismillahirrahmanirrahim. Assalamu alaikum, everyone. I welcome students to lecture 5, which is based on portfolio theory. In this lecture, we will cover the foundation of modern portfolio theory, risk and return, how to calculate expected return, and how diversification reduces risk. By the end of the lecture, the students will be able to understand how portfolios are constructed and how they are evaluated. So let's start a formal discussion on modern portfolio theory. The modern portfolio theory was developed by Harry Markowitz in 1952 and has one of his famous paper, Portfolio Selection. The core idea uh, about the MPT is that every rational investor wants to earn maximum possible returns for a given or certain level of risk. So risk and return are linked, and we need a mathematical way to balance them. One of the main term here used by this theory is that is diversification. So diversification is the key here. This concept states that spreading your investment so that to reduce the total risk in the portfolio. This was a revolutionary idea. Before Markowitz, people looked at individual securities or single investment in isolation, not portfolio as a whole. So this theory negates single period approach here, and that single period approach investor picks securities at the start of the a period and hold them until the end. Uh, Let me give example for further explanation. Let's think of a farmer. If he grows only wheat and the price of wheat falls, he will definitely suffer. But if he grows wheat and some other crops like rice and corn, so a fall in one may be offset by another crops. That's called diversification. MPT tells us how to select a mix of asset that reduces risk but still provides maximum optimal, or we can say, good returns. You can hold a risky stock or asset, but when it's combined with other assets, the overall portfolio risk is reduced. This philosophy aims for higher long-term return, we can say, as well as short-term return, without suffering from extreme level of uh, risks. So here the idea is that you should keep in mind that diversification does not eliminate all of the risk, but reduces the portfolio risk up to certain level. Here, investors need to live their comfort zones, and they should need to take some risk. So consequently, to go for a reward. Let's have an example. Imagine you invest only in the stocks of the technological sector. If the technology sector crashes, you lose heavily. But if you also own bonds and bonds as well as some other stocks like an energy, pharmaceutical firms, health, glasses, etc., then your portfolio losses will be definitely mitigated. Let's talk about the asset allocation. Asset allocation means it is the process of dividing your investment among asset classes like stocks, bonds, and money markets. There are many asset classes available in the industry, so investors should need to look uh, at those. For example, I mentioned some of the investments here. For example, if 28% are invested in large capitalization stocks, mean large companies, 22% in small capitalization means not small companies, 15% are in foreign stock, while 25% are purchased, 25% are bonds, while 18% are invested in money markets, or we can say short-term market, and uh, You can also invest in long-term markets, but I exclude that. So each class of these assets behaves differently. Means some goes in earnings, some boom or some raise in prices in earnings while other decline. So combining these will stabilize the performance, to stabilize our returns. Please note that stocks are highly risky, like common stocks and paper stocks are the real owners of the company, so the business can earn highest returns and the investor can earn much more. But on the other side, if the company goes in losses, then the investor will get nothing. On the other side, we are having bonds, so bonds are safer, as the company will have to pay interest to the investors or the bondholders, as well as they will have to return the principal amount to the bondholder, irrespective of the company good or bad position. But investor combine these different stocks, so investor can get a balanced risk return profile. Let's have an example. Think of a team. If everyone is a striker, the team will be unbalanced. You need defenders, midfielders, and strikers. Similarly, a portfolio needs a mix of all such different assets so to minimize the risk and maximize the returns. How to deal with the uncertainty or the risk involved in your investment or in portfolio. We cannot know the exact future return on a stock. We can only estimate expected return using probability. So probabilities are the main weapons here we can use. Expected return may not equal to our actual return because of the risk involved in that. So let me explain the expected return phenomena as well as the realized or actual return. Expected return is what we predict or estimate an investment will earn, usually based on the probabilities of different outcomes. Like if a stock has a 50% chance of giving 20% return and a 50% chance of giving 0% return, then its expected return will be equal to like 0.5% multiplied by 20% plus 0.5 multiplied by 0%. So it will result in 10% returns. Realized return on the other side is what actually happens in the market after you invest. Combining, continue with the previous example, if the market goes well, you might actually get 20%, but if not, you might get 0%. The key differences are the expected return are forecasted. We can also say that it is the average or projected, while realized return are the actual returns, actual results, or we can say outcome, which may be higher, lower, or equal to the expected returns. Investors need to know not only returns but also the chance of each return. So just knowing possible outcomes is not enough because probabilities matter here. Example, if stock A can give either 10% or 20% return, but both outcomes are equally likely, expected return will be 15%. If, in case, stock B can also give 10%, 20%, but with 90% chance of 10% and only 10% chance of 20%, its expected return will be 11%. Even though both stocks have the same possible outcomes, but the probability distribution changes the attractiveness of the investment. Let's think of a two dice game. An example. In the first, you win rise 100 half the time and rise 200 half the time. In the second, you win rise 109 times out of 10 and rise 200 only once in 10. Both games have the same possible rewards, but the chances are very different, and that changes your decision. This is exactly how investor must think about stocks. So let's talk about probability of returns. For risk-free asset like treasury bills, return are fixed. 100% probability are there with treasury bills. Mean investor will receive the return which is 100% sure. For stocks like Common stocks and preferred stocks returns are different. Our returns can vary. So we assign probabilities to each possible outcome. For example, T-bills, or we can say treasury bills and commercial paper give 10% return or 5% return. So it will be 100% guaranteed. But a stock, a company stock, preferred stock or common stock can give minus 5%, 15% or 25% with different chances. That's why we calculate probability. A probability distribution lists all possible returns and their probabilities. For example, AML stock could give 10%, 20%, or minus 5% each with a certain probability. This example mm, tells us the range of possible outcomes and further in a table. So here we got the idea that PD is the foundation for calculating expected return and risk. So how to calculate probabilities? We are having two types, historical data as well as expert opinion. Through historical data, we look at the past return and we assign probabilities. While the expert opinion, we can say the proficient class of investor can provide us on their opinion. For example, if in the past 5 years, 10 years, or 20 years, oil prices rose 5 times, stayed flat 3 times, and fell 2 times. We can assign probabilities of 0.5, which is 50%, further 0.3, which is 30%, and 0.2, which is 20% probability to that stock on the basis of historical data. Let's have a quick rental example. Oil prices. So we are having oil prices here in the example. Uh, in the flat situation, we are having 10% return with 30% probability. When the oil prices raise, there are 20% return, and the probability assigned to it is 50%. While if a decline occur to 0% returns in oil prices, we are having 20% probability. So multiply return with the probability, then the sum will become 13%. 13% will be the expected return with us. Yes, you should need to note also that the expected return is not guaranteed, it is an average outcome. So the expected return formula with us is that summation of the individual return as well as we have to multiply it with the probability. How we can calculate the risk? So in portfolio, we measure risk by the variance as well as by the standard deviation as we measure it usually, normally. So the steps are that subtract expected return from each possible returns, square the results. Then the next steps multiply the probability sum of all square deviation, which is equal to the variance. And then take square root to get standard deviation. Standard deviation of the portfolio here in this example is 9.2%. You should need to note that standard deviation tells us how much returns fluctuate around the average or mean return. For example, if the expected return is 10%, but standard deviation is 15%, returns could swing or can vary between minus 5% and 25%. Return from a portfolio. Portfolio returns are the weighted average return of all securities. An example, we can take the rise 60,003 stocks. In PPL 15%, we'll have to multiply it by 0.33%, and it will equal to 4.9.5%. In FFC, we are having 12%, while 50% in the previous example, 15%, uh, which will become 6%. In Lucky Simulate, we are having 10% investment with 16% probability, and it will equal to 1.6%. So the portfolio return here with us is 12.55%. So here in diversification here allow the investor for higher returns and for balance risk or reduce risk. Like we can say that right 60,000 rupees or dollars are invested across three different stocks, which yields 12.55% expected return. So this return of the portfolio, this 12.55% of the return of the portfolio is better than investing in just one asset. So these are the examples in detail. And this is 12.55% expected return in the portfolio. Thank you so much.